Good morning and welcome to MarketCast 32 from a beautiful and at the moment sunny Bournemouth. I understand that the heat wave is coming to an end, but as far as the temperature goes, it's still a little bit cool as far as the market is concerned. Okay, let's take a look at where we are. I thought this was a really nice symbol for us to have in terms of our approach to the way that we look at the market over the second half of 2025. Do you know there is a crab somewhere in Ecuador that can't bear the hot weather, the real extremes of heat? So while his mates from different breeds of crab go out and take their chances trying to find themselves food in that hot midday sun, he buries himself in the sand and he waits until conditions are better, and then he comes out and gets the tasty morsels. The danger is, of course, if that weather continues for too long, the poor little rascal could starve under the stand. What are we going to do? Are we going to get our heads down and wait until conditions improve, or are we going to come out and try and keep things ticking over through this difficult summer market? This is the thing that so many people don't understand. We'll talk about all the indices as we run through this deck this morning, but why is it that we've only just now seen both Rightmove start to fall on asking prices and Nationwide move into negative for the first time this year, where we know the new build industry absolutely knows that it has been extremely difficult in the sales offices over the last few months? Well, it's because we're like canaries. The new build industry is like the canary down the coal mine, that early warning system that the market is starting to shift. And when the market shifts, the new build industry feels it before the rest of the mainstream market does. Do you remember this? Remember me putting this slide? But this was back in March. I was actually saying to you right at the start of the year, all of the indicators that we were looking, and the beauty of this of looking at some of these indicators is it's like looking forward into the future. The delays now when a property comes to market, the delays from going to intention to buy to legal completion, 16, 17, 20 weeks. So we can look at the data in terms of offers accepted and know how the market is going to be 20 weeks off into the future. So our view on what's going to happen over the next few months is uncannily accurate. There's no need to be wrong about that. And we were saying back in March that there was going to be a summer dip, and sure enough, we are now right in the middle of that summer dip. Let's just take a look, before we go into the data that sits behind these stories, let's just take a look at the situation where we are. A quick recap. We've seen supply overtaking demand. We knew that was going to happen. It's been building for some time, and now that has turned it in. The general chit chat that you see on social media, certainly amongst the agents, is it's a buyer's market. I do that little buyer's market count, the number of times that I see it buyer's market versus seller's market across the media, and we've moved from what I would call positive selling into negative buyers, and that happened back in March, just after the stamp duty rush was over. So asking prices actually dipped in June according to Rightmove, and normally that doesn't happen. Normally we see a little bit of a blip up, so that's a move against trend, something that always rings alarm bells for me. And of course, I'm sure you're all aware, Monday saw the publication of the June numbers for Nationwide, and it slipped into negative territory. And that's something that I've been forecasting is going to happen for many months now. And it's started now to fall in line with the forecast that we painted out for you right back at the start of the year. However, consumer confidence has rebounded, and now got to be really careful with the GfK numbers, and I'll go into those in a moment or two, but really careful with the GfK numbers these months, because they were literally collected in the 2 weeks up to June 13, and as I'm sure you will recall, June 13 is the very day that Israel launched airstrikes on Iran, and of course the wider effect that has had on the global economy and potential issues with oil prices, inflation and so on. So that would affect public confidence. So these numbers were collected before that. Completions also rebounded in May. So we knew it was going to happen. We forecast it, didn't we? But the stamp duty changes meant huge number of completions in March. That's spike in the graph. We showed it to you, didn't we? Back in January and February, we showed you the stamp duty spikes that have been created down the years, and we said that this year would be no different, and it wasn't. We had a huge spike in completions in March, which meant we got a huge drop in completions in April, and in May it's rebounded a little bit. Still nowhere near the numbers that we need, still nowhere near the 100,000 completions per calendar month that we would expect in a normal 1.2 million market, but it's back up over 80,000, so that's a good thing. And again, as expected and predicted, interest rates were held at the last MPC meeting at 4.25%. No, it was only ever a 50-50. And then, of course, with world events going on around us over which we have no control, no huge surprise there. However, and really importantly, the trajectory as far as interest rates is concerned is still downwards. Just have a look and see where the smart money is, and see the lenders, the institutions coming out with competitive rates below 4%. Inflation fell in May. Whoop-de-doo, because this obviously makes cuts more likely. We'll go into those inflation numbers in a little while. It's very important. It affects us to an enormous extent. So oil prices, another thing that affects us, because that drives inflation either upwards or downwards. And then after the Israel-Iran conflict, they fluttered. US got involved, they fluttered even more, and the dealers jumped up and down for a while, but they have settled, or certainly they appear to have settled. The one thing, the one proviso that I always make is that we have absolutely no control over global economic happenings, the stuff that goes on, geopolitical events out with our control. We can only work with those. So anything that I'm saying here is based on the status quo. What's going on in the press? Well, the big problem with the nationwide numbers, and it's an average number. And as you know, if you're a regular MarketCast listener, the difference in markets between the top of the country, the markets like Manchester, and the worst markets in the UK, like Brighton. So I think it's Blackburn to Brighton. The difference in those markets is almost 10%. So averages are dangerous. But what is more significant, the press love it. It's a big story and they pick it up. So these are just some of the recent press stories. Look at this. Here's the BBC News this was from yesterday. Housing market. House prices see the biggest monthly fall for over 2 years. Great headline there. Here's the Guardian. This was yesterday's Guardian. UK house prices fall by most in more than 2 years. So those nationwide numbers have been picked up by everybody. We knew, didn't we? Us canaries, we already knew where that market was. This came as no surprise to us. One or two other things going on. I've obviously couldn't ignore the situation that happened with Rachel Reeves yesterday in Parliament, where she was crying in front of the TV cameras. The only reason I don't put that in for any political point, what's actually happened as a consequence of that yesterday evening into the night, is that markets have reacted. Markets have reacted. Bond yields have gone up, which means the government is going to be paying more for their debt, more interest, and the pound has dropped against the dollar on world markets. So that does have an effect on us. Those wider economic things do have an effect on us. Just looking further down here, Nationwide cuts Nationwide cuts mortgages rates for new and existing customers. This is Nationwide saying that they are going to be doing mortgages under 4%. There was a lot of press coverage on that. And if we look over here, this story was in the FT Advisor. First-time buyers push up average first house cost by 7%. The relaxation in the mortgage criteria, which the lenders, I'm sure you're aware, back in August 2022, it was no longer mandatory to actually stress test mortgage applications by 3% above the current rate. That was then handed over responsibility for that, handed over to the lenders. And they have started to relax that criteria or those criteria, I should say. And that's interesting, the effect that that's had. And it's seen first-time buyers being able to borrow more. And there's the trend moving towards these longer-term mortgages. All in all, the first-time buyers still fill by far the largest tranche of home buyers, both new and second-hand. and as you can see from that FT story there, are actually driving prices up. Okay, consumer confidence then. Unbelievable set of numbers these, but they were collected in the 2 weeks at the beginning of June. So before Israel did their first raids on Iran. Let's have a quick look at the overall index. The red line here, please, as a reminder, and I know I do this every market cast, but these numbers are dramatically important, and I do hope that I've demonstrated that by showing you exactly how this relates to the sales profile, the volume profile in the UK, and how closely it shows us what that profile is going to be 4 months further forward, 3 or 4 months further forward. This line through here is 0. So 2,000 people answer this survey. If more people answer in the negative, things are going to get worse over the next 12 months. It drives the line into negative. If more people answer positively, things are going to get better over the next 12 months. It moves it into the positive. The red line is the overall index score, and these have shown record lows. This survey is over 50 years old, and the last 2 years has seen record lows on all of these metrics. And the red line here is the overall index score, and you can see where it's come from. Look at this. You'd have to get a JCB and dig a hole in the ground to get down to the levels that this survey has reached in recent months. It is slowly but surely inevitably trying to climb its way back to 0 as confidence slowly rebuilds over a very difficult first year of this new government. But there was a big climb up in the June numbers. And look at this, the blue line here. How do you think the economy is going to do over the next 12 months? Is it going to get better or worse? And that again also took a really big climb up from a horrendous low down there. The last time we saw a low that bad was after the Truss Kwarteng budget, and we all remember that. The green line is the next 12 months going to be a good or a bad time to make a major purchase, a new kitchen, new house, new car. And you can see that also is starting to climb back from record lows over here about 12, 18 months ago. Look at this. That line at the top there, that mauve line, is how are your personal finances going to fare over the next 12 months? Are they going to get better or worse? Very important for the builders, by the way. And you can see that has just sat on that borderline, that 50-50 borderline. Not absolutely sure, but also not too dreadful. And you can see there in the recent numbers there that has just about stayed in positive. So the overall picture, and what does it mean to us? Well, the overall picture is one of worried about the economy, still feel negative about that, but personally I think I'm actually going to do okay. I see that as opportunity for me. It's another one of the reasons, and these climbs out from very, very deep lows earlier on in the year is another reason why I think we are going to see a strong autumn. If we strip away all the details and then we actually just look, and these are the property mark numbers, which I love these. These show the percentage of deals that were done by the property mark members, the agents that are members of the Property Market Association, and asking price or better. We took a big dip down last month, but we're still here. You can see that around 18%, 18% of all the deals done in the UK are still at asking price or better. I expect to see that stay down in that region certainly for next month and maybe into September too. But I do expect it to climb back out come the autumn. Okay, so what are the important signposts in terms of determining where we're going to see the market go next? Well, inflation. Inflation matters enormously to us, and the next inflation numbers are coming out in a couple of weeks' time, July 16. And currently, well, we had good news, didn't we, for the May numbers after this inexorable rise. So this obviously represents the crisis here that was instigated by the Russian invasion of Ukraine in 2022, and you can see that climbing up through there. And of course the coming out of the COVID crisis, which led a huge amount of fuel to that fire. Then we got hit with 16 interest rate rises on the trot to bring that under control, and down we came the other side. And then just over these last few months, we've seen this climbing and climbing and climbing and climbing, which has slowed down the government of the MPC, in terms of reducing interest rates. I know there's, the spectre of that dreadful thing called stagflation. So stagnant economy, but with inflation with it too. But the important number that I've been pointing out to you for the last few months, so much more important than the CPI, which is the Consumer Price Index, which is the number that the newspapers all print, which we know the CPI dropped from 3.5 to 3.4 in May. For us, the OOH number, so the owner occupier housing cost number. These are the people that make up customers, that are the people that buy new homes. And you can see that inflationary curve is really on a downward mark. That for me is another reason why I think we are going to have a strong autumn. That's a really important number. The other important thing to do when we're looking at inflation is to compare CPI, cost inflation, consumer price inflation, with wages. And this chart, which is up, we won't dwell on it, but just to show you what I mean, here is wage inflation, generally gross wage inflation here. So that's total pay here and regular pay. So that up in there. When you take inflation off, here it is, this net wage inflation. And you can see here that net wage inflation is actually sitting there at about 1.5%, 2%. So although prices are going up, wages are going up quicker. Generally, although it is extraordinary, it's true, people are actually better off. What about interest rates then? Well, the next MPC meeting isn't until August the 7th. So we miss out July. There's no MPC meeting in July. No chance of an interest rate cut then until August 7. There is then, I think it's September 18 is the one after that from memory. So we have got one in August and one in September. I think there is every chance that we'll see a cut in August. In fact, I reckon the odds are probably about 75-25 that we'll see at least a 25-point cut. This is what's been going on here. I'm not going to dwell on that. You all know that we saw this. These are the 16 rate rises I was talking about earlier. Then we had this plateau, and then since then the trajectory of interest rates is downwards. That's the way that the government wants it to go. That is the way the institutions believe it's going to go, and I believe it will go that way too. And I think so. We've seen two pauses here. I think in August we will see a 25 points cut, and that will have a big effect on that autumn market. And that's another reason why I think we've got a summer dip, and I think we're going to have a strong autumn market. Just one more reason why. If we're looking at borrowing costs, mortgage costs across the piece, these charts are quite useful at a glance. So looking over here then, this one over here is for two-year fixed rate mortgages at various loans to value. So here obviously at the highest one up here at 95% down to 60%. Those 60% loan to value mortgages fixed over 2 years are now under 4% for new and existing borrowers. Now, we never thought we'd be saying that 6 months ago, did we? And then if we look over to this is a 75% loan to value mortgage over various different loan periods. The 10-year money is the most expensive up here. The very much longer term money. If you look down here, the cheapest money on here is the 2-year money, which they're quoting at 75% loan to value, about 4.2%. But we know we're hovering around the 4. I predicted, didn't I, that we would end the year with mortgage rates beginning with a 3. I still believe that will be the case. I can't see any reason why not. So in terms then of where that leaves us, now, so we can take the facts, we've done all that, and then now there's that little thing about how are people going to react, and how is that going to make the market work in the second half. And I love to use this lovely, what I call the market factor matrix. This chart here is from June 2024. This was a year ago I showed you this chart, if you're a regular MarketCast watcher. And at that time, what was frightening us? High mortgage rates were really doing the damage over here. Consumer confidence was about sat in the middle. Low supply, high demand was starting to be a thing, was over here. Lifestyle changes that we saw post-COVID had really just gone off the chart. Stamp duty changes weren't even on the radar back then. Look where they sat. Now, this is where, so let me update that now to show you where we are right now in that chart. Here comes here come the stamp duty changes over here, because of course we've now moved into deep negative territory, because everybody rushed to take advantage of, well, say take advantage to complete on their property before the reversion back in stamp duty limits that brought them back for first time buyers, brought them right down, and for any buyer from 250 down to 125 threshold. And we saw that, so that's deep into negative over here. Mortgage rates are in negative, but they're moving that way. They're getting better and better and better. So low affordability is also shifting back in that direction. Consumer confidence in the negative, but sort of moving over there as well, less effect. We still have this opportunity up in the top right hand corner to go and buy business during this summer market. That's a strategic decision that will be different for every single house building business in the UK, according to your own individual situation. 10 minutes left. We're going to have a quick race through the indices before I give you my prediction as to what we're going to be doing in the second half. I think I mentioned this earlier, right move, a tiny reduction in asking prices. If you read the trade press, every agent with a voice is saying, be realistic on asking prices. Please be realistic on asking prices. And that's the story for this summer. If you want to be selling during these summer months, just take a really sharp pencil to those asking prices. Excuse me. In this circle here, you won't be able to read it from where you are, but let me tell you that in this circle, that says buyer activity continues to be resilient. May saw the highest numbers of sales agreed and in any month since March 2022. Thought that was worth highlighting out of the Rightmove data in a report for this month. This brand new, this is June, this came out on Monday, and of course this is the one that I've just been talking about. And so monthly change minus 0.8%, and that means then that the annual change now drops to 2.1%. If I'm going to be honest, I forecast, or my original forecast back in January, that we'd be under 2% by now. But we're close. We're close. It's not too far away. That is it. This is doing exactly what we expected it to do, isn't it? So for me, and again, regular watchers of MarketCast will know that this is the index that I take most stock from. And this is the average 3 months on 3 months. This takes out any of the silly anomalies like the stamp duty anomaly. And I've been saying for some time here now that this shows me the trend of where we are headed for this summer. But I expect to start seeing a change in this probably in September as that starts to climb back out. The other thing, of course, is because we're in June, it means that we get the second half regional breakdown from the nationwide, which is always useful to have a look at. When you get the chance, maybe take a look at this on YouTube, look at it in more detail. But this is the point I was making earlier on. So there's Northern Ireland there at 9.5%. Here's East Anglia here at just over 1%. You've got a massive difference in UK markets going on. I won't take you all the way through those, there isn't time, but it's so important that when we're thinking about size and we're thinking about the performance of regions, that we actually think about those against the backdrop of the micro nature of each individual regional market. And of course, that can vary right down to a postcode sector. The Zoopla report, pretty much as we expected in terms of the key takeaways from the Zoopla numbers. Sales are being agreed at the fastest rate for 4 years. So there is some, buried underneath that summer dip and the difficult numbers nationwide, there is some good news in there too. And Zoopla still see annual price changes. And don't forget, the algorithm for Zoopla is a mix of asking price, mortgage approvals and legal completions to give us a really comprehensive guide then on the way the prices are moving. And they've still got prices going up at 1.4%. And when we look at their very clever demand versus supply chart, buyer demand up 7%, stock up 14%, new supply coming in at 8%, and sales agreed at 6%. We're looking for equilibrium there. That's what we really want. All the time that this block here is higher than that one over there, we move towards the buyer. When it reverses, we move towards the seller. It really is that simple. Mortgage approvals, well, that shows it's a little climb here. that just blipped up mortgage approvals to 63,000 for May. And don't forget, that is our window into the future. If there's 63,000 mortgage approvals in May, it means that we'll see about 90,000 completions in August. So we can literally, I can almost, I can tell you now what the August legal completions are going to be. It's easy, isn't it? That's no rocket science in there. That's just the way it works. We'll continue to see that climb. Of that, I'm absolutely certain, and we'll see it climb certainly when we move into September. This number will be coming back up to 66, 70,000, which is where I would expect it to be. The RICS, a really quick look at the RICS numbers. Their headline here: sales market momentum remains relatively soft. What a lovely way of describing it. That's what I would call, you and I might call, a summer dip actually, although sentiment on the near-term outlook turns less downbeat. I'll show you that in a moment or two. What I call the canary slides. Don't forget, here we are in an industry that is the canary down the coal mine. The canary slides here are new buyer inquiries, all still well in the negative. It's exactly what you would expect in July and August, isn't it? Of course. And then if we look at new vendor instructions, so stuff coming to the market, you can see it all sits around about the center line, allowing for regional variances. So that's these are the buyers, these are the sellers. That's a really great way of us being able to look forward. And so we look at this market changing here, and we look at these mauve blocks moving away from these blue triangles. And let me tell you, that gives you the very best guide you could possibly have to what's the activity that's going to be going on in a month or 2 months' time. Where does that bring us in terms of how the surveyors feel the market's going to move? Well, over here, this is volumes, the number of properties being sold. The blue, azure blue dotted line here, they're saying this works a little bit like the GfK consumer confidence chart. They're saying more to be sold over the 12 months than last year. The short term, there's been a rebound of confidence here. It's coming back to about zero over the next 3 months. Prices, well, huge majority of surveyors believe that prices will be higher at the end of the year than lower. And again, a rebound in confidence here. So it's just a bit in negative. So the majority just about believe prices are going to fall over the next 3 months rather than rise. So where to in the second half? Well, I'm delighted to say that, I say delighted, I am relieved to say that the nationwide numbers have now started moving in line with the forecast that I've been showing you all year and refusing to change. And at last, here it is. It's happening a month later than I thought it would. But you can see now the dark blue blocks are actual numbers. So this is the actual nationwide number from last week and from last month. The June numbers, and you can see here 2.1%, that just sits above the 2% mark. I thought it was going to be down here around 1.5. I still believe that we're going to come down to here over the next couple of months, and that means that the average price of a property in the UK, well, it fell a little bit last month. I think it will fall a bit further in the next couple of months as we go through this summer dip. That's where it is. Crucially, for all the evidence that I've seen, I think that we are going to see it start to rise and come out through the autumn. So that's the most important thing. Why do I think that? I'm asked it all the time. When I take this presentation out for clients and groups of sales teams, they ask me, well, why are you so convinced? Here are my reasons. One, the relaxation of stress testing criteria by the lenders, really important. Availability of longer term mortgages, downward trajectory of inflation, which will almost certainly mean likely reductions in interest rates. I am still convinced we'll see interest rates sub 4% by the end of the year. Consumer confidence is starting to recover, and then the rebound of volumes of sales after the hiatus caused by the stamp duty changes in March. That's why I believe that we are going to see an autumn into winter strong market. So to finish off then, and in summary, the dip we all felt that was happening was finally, we've now seen it reflected in the data. We're canaries down the coal mine. We see it before the general market, and it has been a struggle over the last 3 months in sales offices, new build sales offices all around the country. You've got to be creative, got to be aggressive if you want to keep the clock ticking over. sales above 0.5 per live site per week, well, then it takes a little bit of driving, and that costs money, of course. So it looks as though oil prices now have stabilized after the fluttering, but obviously I'm unable to see in the future, particularly as far as geopolitical things are concerned. If things settle and stay calm as they are right now, well, then I think that we'll see fuel prices being part of a general fall in inflation. I'm still staying with my forecast that we're going to end the year at plus 1.5%. So in other words, at the end of December, the average price of a property in the UK, according to the Nationwide, will be 1.5% higher than it was the year before. And then you have to actually translate that down to how that works in your various micro markets, but generally 1.5% higher. And despite the distortion that the changes in stamp duty brought, I still believe that we are going to end up with 1.2 million. That's starting to be a little one of those things that keep you awake at night, wondering whether I've overdone that. I'm staying with it. I think it will be 1.2 million, which means we do need to have a strong autumn and winter. And I think that the new home share is going to stay around 10%. I nearly finished bang on 30 minutes. The next MarketCast is Thursday, the 4th of September. We've got a new member of the team this morning who has done brilliantly so far and looks completely relaxed. So many thanks to Luke. A special thanks, I've got to say, to James, who I hope is watching this, that has been responsible for the tech on MarketCast for the last couple of years and done a brilliant job. Well, Luke is doing a great job this morning. Big thanks to Josie. Big thanks to Hannah for making up the team here this morning. I hope you've enjoyed the last crazy 30 minutes, and I will have a super August. Don't get sunburn, and I'll see you again in September.